Welcome. It is 18 March, year of our Lord 2025, and we're going to jump into a lesson on investing. So here we go. This is, or has been, probably the most popular topic in the course of personal finance at the University of Houston. So here we go. This is one of my favorite topics, investing, and we're gonna cover. Well, we're gonna cover a lot. Let me just get started. It's a little bit early. We're still waiting for some folks to join the Zoom meeting. In fact, let me jump over to the Zoom meeting and see if I can. I have too many screens going. So I'm looking for my Zoom and I'm not seeing it. Zoom meeting. Well, here we go. Okay. Back to the course. Okay, I'm going to get started in just about 2 minutes. It's about 10:03 a.m. and we're going to jump right in. I hope you had a good spring break. Nice, comfortable, amazing weather. It wasn't too hot, wasn't too cold. It was just beautiful. Great time for motorcycle riding. Spent a lot of time on my Goldwing last week, and it was delightful. So I hope you had a good time. Let's jump into, I'm going to jump on over here to, let's see. First thing I'm going to do is just take a look at the there we go. This is the post. So in the video, you'll see a link in the video. If you're watching on YouTube or on LinkedIn or Facebook or X, you'll see a link in the post. It'll take you to this, or it'll take you to this post. A link in the video down in the comments will take you to this post. So this is the content that I created just for today to kind of give me a blueprint for today's lecture. There is a lot to cover, and you'll see as we go through this, there's a lot to cover. And when you're doing your homework this week, you have a lot of reading. It's not hard reading, and I hope you'll spend some time to understand it. We're going to talk about one of the things I wanted to highlight is Wikipedia says investment, according to Wikipedia, investment is traditionally defined as the commitment of resources to achieve later benefits. So there you have it. It's a pretty good definition. But how do you do it? And so what I've done over the years is I've designed this lecture, this week of study around the perfect investment for a young person who has a long time to invest. So for most of you, as college students, number one, you are getting ready to start your investing career. So you have a good long time horizon. So the strategies that I'm going to cover today are designed to help you maximize returns and minimize risk, and they will be designed for you. So we're going to talk about 4 investment strategies. Let me just jump here and see if we can review these real quick. So how to invest. So these are the big topics we're going to cover. And just so you know, you're going to, hold on, I got to get rid of this and this. There we go. Just so you know, we're going to be working on investments for the next several weeks. As we get closer to the end of this semester, we're going to spend a good amount of time on investing. So today is kind of an introduction Today is, I'm going to cover a couple of major topics, but you're going to go in deeper next week and the week after, and we'll continue to talk about them. But the first thing I wanted to just mention is that we're going to talk about types, how to invest, types of accounts is a big, important part of investing. So you may recall the three laws of personal finance: the law of spending and saving. Spend less than you earn so you can save more for what matters most. That's the first law. But the second law is the law of tax advantaged investing. And that's where you learn that investing is really, it's a lot about the type of account that you're putting your money in. So we're going to talk about that. And then naturally, the types of investments, we'll go over that because types of investments is very, very different than a type of account. And then I'm going to share the 4 investment strategies. I'm going to highlight those for you today. And I'm going to try to wrap it all up in what I call the perfect investment. In my book, Make Your Money Count, and every one of my books, I always talk about the perfect investment. And in this lecture, in this week's lesson, I try to wrap everything up into the perfect investment, which is, by the way, a 401k. If you go to work, assuming that you're a college student and you are in a business college, and assuming that you get a job in the business world, you will very likely have access to an excellent company 401k plan. We hope that anyway. And as you look for your dream job, that's one of the things I want to help you prepare to do, is to identify what's the best 401k plan for you. Because the 401k is really, it's really the perfect investment. And I'll talk about that today. So that's one of the things we're going to go over. Another really big one, and it is one of the 4 investment strategies, is asset allocation. And I just want to mention that in today's lecture, in this week's lesson, in your homework, I want to kind of take the pressure off and help you understand. I know many of you are not really experts in investing, and many of you don't even want to be experts in investing. And that's okay. I'm going to teach you just enough to hopefully whet your appetite to know that you can become an excellent investor if you just learn some basic things. And so I'm going to talk about 4 investment strategies that are specifically designed to help you maximize returns and minimize risk. And those strategies are all based on some fundamental basic things about investing. And you need to understand some of those fundamental basic things in order for these strategies that I'm going to show you, in order for them to make sense to you, and in order for them to be powerful in terms of influencing your behavior as an investor and giving you the confidence that I want you to have, that I think hopefully you want to have as an investor. In order for these strategies to do that, you have to understand some basic building blocks of investing. And so in Money Study Group, you've been given some reading assignments that will help you do that. But they'll just be a good way to start. You will want to also spend a little time and do your own research and continue to learn and grow, because I'm giving you kind of the roadmap. I'll give you a blueprint as well for how to build the perfect investment, because I want you to be able to do that on day 1 when you get that job. I want you to be able to do that, to set up your 401k so that you take advantage of these investment strategies. So that's what we're going to try to do here today. So let's get started. The perfect investment. This is the way to maximize your investments. First is diversify your investments. And then we're going to talk about these 4 strategies, but it's basically diversification, asset allocation, And asset allocation, by the way, is the single most important determinant of your portfolio's returns. So, like I said a minute ago, in order for this strategy, in order for the perfect investment to actually work, asset allocation is really important. So you will be learning some things about asset allocation. I'm going to tell you a story about Farmer Joe today, and I'm going to try to illustrate dollar cost averaging. I think dollar cost averaging is, hands down, the most powerful investment strategy available to you because it just works. So I'm going to cover dollar cost averaging. It's one of the strategies that will help you maximize your returns. And then we'll talk about rebalancing your portfolio. That's another strategy I want you to understand. One thing that I like to make sure you think about is investing consistently. And I'll teach you how to do that. In fact, I'm going to set it up, help you set it up so that you're investing consistently without even thinking about it. And that really is the way to create the perfect investment. So that's what we're going to focus on. Let's see. How to invest for success. I think I went to the wrong one. I did. The perfect investment. Types of accounts. So let's talk about types of accounts. Like I said a few minutes ago, the second law of personal finance is the law of tax advantaged investing. And this can be a little confusing at first, so I want to kind of make sure that I clarify types of accounts versus types of investments. So when you hear someone say, hey, I'm investing in a Roth IRA, that's not really true. It's not grammatically true. It's like you don't invest in a 401k or an IRA. That is a type of account that you put money into, you contribute to it. But then you have to select an investment. So let me see if I get this right. So the company 401k, I talked about that for a minute. I want to just kind of tell you how this works. So if you don't understand how a 401k works, let me just spend a minute and see if I can. I think I have a screen for this. Let me just see. Yeah. So it's kind of the perfect investment. I think I have. So let's just talk about the 401k. If you don't know how it works, let me explain to you how it works and why it's such an important part of your investing future. And this is going to be this week's class collaboration. So I want you to listen to what I'm about to say about the 401k and why I think it's the perfect investment. And I want you to be able to just kind of give me a summary in your own words in this week's class collaboration conversation about the 401k, because you're going to do some homework. One thing you're going to do is you're going to find out what will it cost you to retire. So how much money do you need to save to be able to retire the way that you want to retire? And so I want to help you take the pressure off you, because when you do that this week's assignment, part of it is to just calculate what is it going to cost to retire. And once you see that it's a pretty big number and it's pretty challenging, you'll start to see that if you invest in a 401k, it becomes a very powerful element, a component of your financial future, your investment program. So I want to make sure you understand how it works. So here's how it works. Day one, when you walk into that new job, you're going to go to orientation. And they're going to tell you where to park, where the bathroom is, and a whole bunch of other stuff, including a lot of paperwork for signing up for company benefits. And one of the benefits will be, hopefully, if you select the right job at the right company, you'll have access to a 401k plan. Now, if you work for the government, it might be a 457 plan. If you work for a nonprofit organization, it could be a 403b. But these are all the same basic thing. They're a tax qualified, tax deferred, tax deductible investment. And so day one, I want you to know what to do when they give you that paperwork. So first thing you're going to want to do is say, yes, I'm going to take advantage of this 401k plan. Yes. The second thing you're going to have to do is they're going to ask you, how much do you want to invest? How much money do you want to put into your 401k? So again, you're making a contribution. At that point, it's not really an investment. We'll talk about that in a minute. But day one, yes, you definitely want to take advantage of the 401k. The second question takes a little bit of research, and this is a research that I want you to do this week, and this week and next week, really. In that job that you selected as your dream job, I want you to find out, what is that company, what does their 401k look like? You can Google that. It's pretty much public information. But I want you to know, what is that company 401k? How does it work? And the number one thing I want you to know is, what is the company match? So a 401k has a beautiful thing that makes it the perfect investment, and it's called the company match. So let me give you an example. Let's assume you go to work for Shell Oil Company. I don't know what it is today, but at one point they paid an 8% match. So here's how that works. Understand this, because you're going to do a little research, and it'll be super easy for you to figure out how your company, your dream job, how that will work. So number one is, you go to work for a company, and let's keep the math super simple. Let's just say you make $100,000 a year, and the company is going to match 8%. So how does that work? Think about it. Go ahead and leave a comment. If you're watching live on YouTube or at 2 in the morning or on LinkedIn, just leave a comment and explain. If you make $100,000 and the company offers an 8% match, what does that mean? How does that work? What do you have to do? So here's the answer. I'm going to pause and let you leave a comment, or you should just hit the pause button, leave a comment, and then come back and watch and see if you got it close. And that'll be fun. And then you can leave another comment to say, yeah, I nailed it. So the first thing is, if you know it's an 8% match and you know you're making $100,000 a year. So in that scenario, you would then be able to contribute up to $8,000 out of your paycheck into your 401k. So you make $100,000 and you have them withhold $8,000 each year. But what happens is, because you contributed 8% of your income and they match 8% of your income, then they will go ahead and contribute or match another $8,000 or 8% of your income. And we're using $100,000 of income just to keep the math super simple. So at the end of 1 year, instead of having $8,000 in your 401k, you now have $16,000 in your 401k. That's a huge benefit. That's why I call it the perfect investment. So that's the first thing about a 401k. The second thing is, that makes it a perfect investment, is, remember, you contributed $8,000, right, into your 401k in order to get the match. And this is what I want you to be able to do and be prepared to do on day one when you graduate and get that job. So the first thing is, you're going to get the match. But the second thing is, when you do your taxes, and my birthday is April 15th, which is tax day, and I know about tax deductions. My first child, my son, was born on December 31st. So I got a full tax credit for the full year, a tax deductible tax credit. It was actually a credit at the time. So tax deductions are beautiful things. And when you contribute to a 401k, you get a tax deduction. So that $8,000 that you put in is tax deductible, which means it reduces your income, which means you don't have to pay tax on that $8,000. It's tax deferred, which means when you get old like me, once you're 59 and a half and you start taking money out of that account, then you pay taxes. But by that time, The hope is you're in a lower tax bracket and you're paying lower taxes. So you get to deduct that while you're making good income throughout your life. So that's the second thing. The first is the match. The second is the tax deductibility of the 401k. And I'll just tell you the third thing is this is where these investment strategies that we're going to get into come into play. And they are they're going to be really powerful, and they're really going to help you maximize returns and minimize risk as long as you're doing this in your 401k. So these strategies that we're going to talk about are, let me get them up here, and let me get that out of the way, and I'm going to get this out of the way. So the 401k is what I call the perfect investment. And as we go through today's lecture and talk about these strategies, I want you just to keep in mind we're trying to put into context these investment strategies so that you can think of them as part of your 401k. Now, they will help you. These strategies and what you learn this week will definitely help you in every area of investing. It doesn't have to be your 401k, but you do need to understand the benefits of your 401k. Next week, you're going to learn more about types of accounts, including the traditional 40 or traditional IRA, which is very much like the 401k. And I get this question a lot: what happens if I leave my job and I had a 401k there? Well, normally, not always, but normally you will want to roll over your 401k funds into a traditional IRA. So for example, if you did work for Shell and you worked there for 3 years, and hopefully you did work there for 3 years, because this is a secret that I'm about to tell you that you should remember, because it can make a huge difference in your financial life. If you go from job to job to job, that may not be a bad thing. Maybe you get a promotion, maybe you get a raise, maybe you get a better job, get to live where you want to live. However, if you're working for a company and you're contributing and you're getting that match and you leave the company after 2 years, typically it takes 3 years to be vested, even though you get to keep the money you put in your 401k, but you don't get to keep the money that they matched if you leave that company too soon. So just plan ahead, and just plan on staying there for 3 years to be vested. If you're going to change companies, don't do it until you get vested, because that's a pretty good chunk of change. And anyway, that's important little tidbit. So again, when you leave one company and you've contributed in your 401k to that company, you're typically going to want to roll your funds into your own individual retirement. Most people think IRA stands for individual retirement account, but it actually stands for individual retirement arrangement. So there you have it. And the next thing is that I want to mention in terms of types of accounts is you're going to learn about a Roth IRA. It's the only tax-free investment that I know of. So with a traditional IRA and also with a 401k, you get, it's tax deferred. You get a tax deduction. You don't have to pay tax until you take the money out. But the beautiful thing about a Roth IRA is that you don't ever have to pay tax on the earnings. Now, you don't get a tax deduction, but you don't have to pay tax when you take the money out. So it's a great thing. You're going to learn about it. I just want to plant the seed this week because it is a type of account. It started in 1998, and for those of us who were investing in that time, we said that's a good idea. Anything that the IRS lets you do, remember, the second law of personal finance is the law of tax-advantaged investing. The IRS makes the rules. Our job is to take advantage of them, and the Roth IRA is one of those rules. You can only contribute so much. You're going to learn that. That's going to be next week's assignment. What are the contribution limits for this year? So you'll be learning that as you go along for next week, as you get into more about types of accounts. The 401k Roth is very similar. It's a relatively new provision. Hopefully your company will have a Roth 401k, but that just allows you to invest in your company plan in a tax-free way. So it's pretty cool. One other type of account I want to mention, I want you to be aware of, is kind of the all other type of account. It's a taxable account. This is where probably most of the world's money is in some type of taxable account. So if you just go set up an account at Charles Schwab or E-Trade or Robinhood or even at your bank, typically those accounts will be taxable. They don't have any tax benefits. So there's all kinds of things that you will want to learn about the way that you title accounts for estate planning purposes, the way you name your account and how you hold it. There's tons and tons of information, and that goes way beyond the type of accounts I want you to learn about in this course. Just for the purpose of investing, though, I want you to be able to know and distinguish different types of accounts. So that is that. Let's see what's next. Types of investments. So let's go to types of investments and just talk about that for a minute. When we get into these strategies, when I go over the strategies, you're going to understand that. So we talked about types of accounts, and by now, hopefully you know the difference between a type of account and a type of investment. So when you talk about investing, whether you're investing in your Roth IRA, your 401k, your IRA, or your taxable account, you have all kinds of choices for what to invest in. So the first one I want to just mention is an individual stock. It could be an individual bond as well, which you see down there on the list. But think about Apple or Tesla. Ooh, Tesla's getting hammered this week. I think. Let me just check and see what Tesla's doing at the moment. I'll show you in just a second. Tesla was down 15 bucks a few minutes ago. Let me just show you. I'll just show you. I'm going to hide that, and I'm going to go to Me iPad. So this is Tesla today. Tesla is down. What is it down? It's down $9.98. NVIDIA, so again, individual companies. These are companies that you can invest in, and you can do this in your 401k. You can do this in your IRA, your Roth IRA, and there's some risk, and you're going to see, like, we're looking at, let's just look at, so this is ExxonMobil. This is a company I like to invest in. Trying to get that up. Now look at that chart. ExxonMobil. We're going to talk about dollar cost averaging in a minute, but right now I just wanted to kind of give you the heads up about investing in individual stocks. So let me get back to my buttons here so I can go to the next talking point. So you got individual stocks, right? You know you can invest in individual stocks, and there are all kinds of companies that are traded publicly, and if they're traded publicly, you can invest in them. So that's what an individual stock is. Whoops, I went to the wrong one. Individual stock and a mutual fund. So when I started investing years ago, one of the I'm kind of old. So mutual funds were a new novel thing a long time ago. But what it does is a mutual fund gives you the ability to invest in one thing, one fund, and it becomes diversified. And that one fund, a mutual fund, has something called a manager. I want you just to understand what a mutual fund is. So you're going to do a little research this week, a little reading, and you're going to understand what a mutual fund is. And I wanted to just mention it because it is a type of investment. And it is one way to reduce risk because it automatically gives you diversification, which is the number one investment strategy we're going to cover, is diversification. And it also it doesn't really help always with asset allocation, which you're going to learn about, but it gives you diversification. But the problem with a mutual fund, the reason I don't love mutual funds is because you're paying a manager an extra fee. And that might be good. You might think that's great, but I'm going to teach you how to use these investment strategies in such a way that you can really reduce your cost, which ends up giving you better results by using other types of investments as opposed to a mutual fund. An index fund is similar to a mutual fund, and then you have individual bonds. But here's what I really want to highlight. So you're going to learn about asset classes this week and next week, things like large cap stocks. In fact, I think, let me just see if I have asset classes. No. Do I have? Yeah, there we go. So asset allocation. Hold on, give me just a second. I think I don't think I have a screen for, I've got types of investments, investment strategies. Yeah, here we go, asset classes. And this is next week's assignment, more than this week, but I just want to mention it. So company stocks are very, there's a lot more risk in investing in a stock than a mutual fund, obviously. And I'll talk a little bit more about the difference between a mutual fund, an index fund, and an exchange traded fund, because I want you to understand that. It's kind of inside baseball, but I think for some of you it'll be very interesting and it'll be helpful. But company stocks come in all kinds of shapes and sizes. And so when we talk about asset allocation, remember, asset allocation is the single most important determinant of your portfolio's returns. So I want you to understand what it is a little bit. And first thing is, you have large cap, you have small cap, you have mid cap, and you have international. And these are different types of asset classes. So just plant that seed in your mind that there's this thing called asset classes. And that's what we're talking about. We're talking about, what kind of stock is it? Now, when you do a mutual fund or an index fund, you do that, you select those. There's hundreds, thousands of these different types of investments. So you could be looking at a mutual fund. Let's get back to types of investments. You could be looking at a mutual fund. Let me get back to types of investments. You could be looking at a mutual fund that is designed to help you invest in large cap stocks. And if you did that, you'd want to have another mutual fund that invested in small cap stocks or international stocks. So just understand that when we talk about asset classes, we're talking about different types of investments that are different. They're different. And that's important, especially when we get into asset allocation and dollar cost averaging. And just trust me, that's going to be very important when we get to that topic. So I'm just trying to set the table for you to understand what these different things are and how they fit into the perfect investment. So again, mutual fund and index fund. What I want you to understand about these two guys, index fund, mutual fund, as opposed to an exchange traded fund. So an exchange traded fund is my favorite. If you're a professional money manager, you typically like exchange traded funds because an ETF trades like a stock. What does that mean? And why does it matter? It may not matter to you too much. It matters to professionals. But I want you to understand it because I just want you to understand types of investments. So I told you that a mutual fund has a manager, right? An index fund is just like a mutual fund, except it doesn't have a manager. So you could buy an index fund that's large cap stocks. That's like the S&P 500, big companies like Shell and McDonald's and Coca-Cola, big companies. That's a large cap And you could get a mutual fund that is that flavor. And that's a pretty good idea. So you would be paying someone to pick and select big companies in that fund. You would be paying an extra fee for that. So with an index fund, you don't have to pay the fee. You just get the whole index, like the S&P 500 large cap, or if you're doing small cap, whatever the asset class is. When you do an index fund and you select an index fund based on that asset class, you basically get to buy that asset class without paying an extra fee. So mutual fund, you pay a fee for a manager. Index fund, you don't, but they're pretty much the same thing. What makes an index fund different than an exchange traded fund? For one thing, you don't pay a fee. There's no manager's fee. You pay a fee for every investment. But the fees on an exchange traded fund are really low, typically, depending on the ETF that you're buying. I'll show you some ETFs. In fact, I'm going to show you my favorite ETF right now just for fun. I'm going to go here. Now I got to go back over. Just give me 1 second. I'm going to go, there we go. So this is the SPY. It sounds like SPY. That's what it's called. It's the S&P 500, and this is an exchange traded fund. So if you were going to invest in one investment, just one, this would be the one you'd want to invest in. You're not going to be able to invest in this in your 401k, but as an investor, if you had an IRA, this is what you would want to invest in, is the S&P 500, which is the SPY. So you can see what it's doing right now. That's a 3-month chart. President Trump is talking about tariffs, and you can see that chart, how much the S&P 500 has come down this year. It's come down quite a bit in the last month. And the reason is because President Trump is talking about tariffs. And there's all kinds of uncertainty in the market. Now what you're seeing, it's called TLT. That's another ETF, but it's a bond ETF. Okay, hopefully that's starting to make sense. I could be showing you mutual funds or index funds, but I don't mess with those. I love ETFs, and that's typically what I would be trading for a client. Like, I build portfolios for clients. I just want you to understand different types of investments, and ETF is one you should know about. This is the whenever you watch the news and they say the market's down 500 points, typically they're talking about the Dow, which is really not a good indicator of the market. Not as good as the S&P 500. Again, inside baseball. But this is the ETF. It's called DIA. They call it the diamonds. This is the ETF you would invest in if you wanted to invest in all of those Dow stocks. There are 30 of them. Again, just so you know, if you picked one investment, you'd want to go with the SPY, because the S&P 500 is the most watched index on the planet. It really is. As the S&P 500 goes, so goes the market. Now, that doesn't cover tech. Like, this is an ETF. It's called SMH. If you wanted to invest in chips, this is the one you'd invest in. But look at how volatile that is, how much it goes up and down. So this is the Qs. I'm just showing you a bunch of ETFs to give you an idea how these investments work. So this is the NASDAQ, basically. You hear people talk about the tech sector. Well, this is it. This is an ETF, an exchange-traded fund that you would invest in if you just wanted to own the NASDAQ, all those big companies, Apple, Meta, the list goes on and on, Google, Alphabet. But look how much it's gone down. That's a 1-year chart. This is a 3-month chart. Ooh. So that seems painful, right? It's scary, all that risk. That's why I want you to come back. I want you to pay attention to the 4 investment strategies that we're going to cover, because when you start to understand the the investment strategies and how they work, you're going to start to see that they're designed. I was going to say it's a good thing that the market goes up and down. And frankly, it is a good thing. It is a thing. Whether it's good or not, I guess you got to decide, but it is a thing. If you ask me, what's the market going to do from here? Is it going to go up or down? It's going to do both. It's going to go up and it's going to go down, but it's going to do what it does. But the thing is, over time, if you have a plan, and I'm going to be giving you a plan using these 4 investment strategies, and if you use them, you will discover that you get to take advantage of the market's ups and downs, and that's what I really want you to be able to understand and do. So, types of investments, 4 investment strategies. Here we go. So the 4 investment strategies we're going to talk about are diversification. I usually tell a story about Enron. And when you do your homework this week, you'll be able to watch a video about Enron. Enron was a major American saga. And when Enron was going down, literally when the company was going down, I had a couple of clients who were with Enron. One of them was Andrea, and Andrea was a middle manager, and she was very smart. She did not just continue to invest in Enron. She was very diversified. She invested her 401k in all kinds of things, not just Enron stock. But then I had this other guy, Bill, who was also a middle manager, and he bought into everything that Enron said. And if you remember, Enron, it was this stock that just went up and up and up, kind of like Palantir did this year, or Tesla did earlier this year. But anyway, my client, or prospective client, he'd never really turned into a client. I ended up working with his widow. She had no skills. She'd never had a job. She was married to Bill, who was a middle manager at Enron, and he invested everything in Enron. And when the company stock tanked, the leaders at Enron told everybody there's never been a better time to invest, double down on Enron. And so the poor people who believed that invested more into Enron. They put their life savings, and this guy Bill did that. He put his entire 401k in company stock. It's not a good idea. Think about it. If you work for a company and you put all your money in that one company stock, that's not diversification, right? That's like your job. If that company goes bankrupt, goes out of business, not only are you losing all of your investment, but you're also losing your job, your way of earning an income. It's just not smart. Bill was not smart. And when Enron tanked, he ended up losing everything. The stress gave him a heart attack and he died. I mean, that's the short story. But diversification, it's a hugely important, very simple strategy, and it's one I want you to know about. So that's why it's on the list. And it can't, for 4 investment strategies that are designed to help you maximize returns and minimize risk, we can't have that list without having diversification. The next one is asset allocation, and I wish I could teach this to you, but I really can't, because until you understand asset classes, you can't really understand asset allocation. But once you start to put into your mind what different asset classes are, it will become magically clear to you that asset allocation is the single most important determinant of your portfolio's returns. And so asset allocation is really important. You'll be working on that in your financial plan at Right Capital as well. The next one, I went the wrong way. The next one is dollar cost averaging. And dollar cost averaging, let me see if I can find. dollar cost averaging. It is, maybe I have the wrong little screen show there, but dollar cost averaging is, in my opinion, let me see what this one looks like. Okay, hold on. I want to tell you the story about Farmer Joe. Let me see if I can find that. So we're going to talk about dollar cost averaging. Hopefully I can find Farmer Joe. There's so much content I've created to tell the story about Farmer Joe, but I'm not saying Farmer Joe. That's crazy. Let's see. I'm looking for dollar cost averaging somewhere in my list. I wish you could see. I'm looking. Yeah. So got portfolio rebalancing, dollar cost at, oh, there we go, cows. That's what I was looking for. I wanted to show you the cows, but I don't have my picture there, so I'll have to fix that while I'm talking. So Farmer Joe is, he's a guy that, he was a client of mine, and Farmer Joe had, he had a farm. And in his farm, hold on, I'm doing a little work as I'm working. I'm going to go back to the cows, and I'm going to install this camera here so you can see me. You may get to see me do a little work on my. You're going to get to see me do a little work as I play here. Sorry about that. I know you can't see me completely, but I am swapping some things around. There we go. Okay. There you go. I just created a new scene with Farmer Joe. So I'm going to tell the story about Farmer Joe. I think I'll tell the story. Sorry, I'm not as set up as I should be, but I'm looking for Farmer Joe. Yeah, here we go. I'm going to jump on over here to me, iPad. Maybe I'll go here. Here we go. I'm sorry. About to tell you a story. It's a good story. Maybe it'll be worth listening to. So here we go. Farmer Joe. Now this is the post. I told you earlier that there's a link in the comments to this post. And this is the post that I'm scrolling through that has a lot of information. So it starts with diversification, and I just talk about what it is. So if you want to go a little deeper, just take a look at this post. This is an image for diversification. It's actually illustrating a mutual fund. So what you see on the right side there is a mutual fund versus investing in a single stock. And if you invest in a mutual fund, you have all those cables, and that's the manager's job, is to pick all of those cables and put them, those are companies, right, that hold up the elevator. So this is just an illustration. If you have one company, like I showed you Tesla, if you look at Tesla stock, that's a little scary, right, when that goes down. So if you're the manager and you want to, that's a picture of Enron. So there's a little story about Enron as well. But if you're the manager, the mutual fund manager, your job may be today to get rid of Tesla and replace Tesla with another company. That's what those cables are. They're companies. And the manager's job is to select them, remove them, add them. So that's what you're getting when you pay the fee for a mutual fund versus investing in one company like Tesla. So anyway, that's, again, more information here. Asset allocation, I talk about it as when your portfolio has the right asset allocation. It's like, think of a pie. If it's smooth, asset allocation allows it allows your portfolio to run smoothly. A balanced portfolio. This just lists some of those. Again, this is the post there's a link in the video. This lists the different asset classes uh, and what asset allocation is based on asset classes. So you really need to know that. Here's Farmer Joe. So I'm going to tell you about Farmer Joe. I think I'll just let Farmer Joe sit there. But this is a chart. I've already filled it out. I usually fill it out when I'm telling the story, but I'm not going to do that today. So for the next few minutes, I'm going to tell you this story about Farmer Joe, and then we're going to wrap it up because we're going to be out of time. But Farmer Joe this is dollar cost averaging. I want you to understand dollar cost averaging. It is a strategy for investing. And this is the story of Farmer Joe to help you understand dollar cost averaging. It is in my opinion, it is the most powerful investment strategy you could possibly use over your investing lifetime. So dollar cost averaging, this is Farmer Joe. He has a farm, and he called me up. He said, Jim, I want to diversify. I want to invest in cows. So I tell this story in my book, except I use pigs. No, I use cows. In my book, I use the story of cows, Farmer Joe, because I wanted to use the Farmer Joe story. But it's based on a story in my book about my Uncle Hank, who really didn't invest in cows. They invested in pigs. So this story is really based on pigs, but the story, we use cows. I don't know why. The editor wanted to use cows. And I said, okay. So here we go with cows. So what you see here is you're going to see that Farmer Joe, he decided to invest in cows. So I helped him set up a plan. I said, let's go ahead and set up a systematic investment strategy, which is what I want you to do in your 401k. That's what I helped Farmer Joe do. So he had chickens, he had pigs, he had ducks, he had all these different things on his farm. He had crops, but he did not have cows. So think of it as an asset class, a cow. It's like he didn't have cows, so he wanted to invest in cows. And he started to invest in cows. We said, okay, let's start with $100 a month. Okay, just for this illustration, you're going to invest $100 a month in cows. Farmer Joe's like, okay, no problem. That sounds good. So what we did is the first month, cows were $100 a head. So he invested $100. How many cows did he get? Go ahead and leave a comment. Super simple math here. If he's investing $100 a month, this is dollar cost averaging, cows cost $100 a head. So how many cows does he get month number one? He gets one cow. The second month, cows go up to $50 a head. So he invests how much? $100 each month. That's always how much he's investing, is $100. So he gets to buy 2 cows. The next month, cows drop to $25. You can't see that very well. I could be writing it, but I'm not. So they drop to $25 a head. How many cows does Farmer Joe get to buy? Remember the stock chart that I showed you for Tesla? If you were buying Tesla stock, today would not be a bad day to buy some more because it's on sale. Farmer Joe decided that he needed cows on his farm, and he set out to invest in cows, and I helped him set up a plan to get as much cow for the buck as he could. And we did that with dollar cost averaging. So again, month number 3, cows are $25 a head. He gets four cows. The next month, the 5th month, 1, 2, 3, the 4th month, cows drop all the way to $20 a head. Think about it. If you were investing in cows, if you needed cows, if you wanted cows, if you had a purpose for owning cows, would you be happy or would you be sad that the value of cows had dropped? Think about that for a minute. because I want you to think about that as an investor with a long time horizon, knowing that over time, the price of cows, what do you think it's going to do? Can it keep going down? It went from 100 to 25 bucks a head. And that's when Farmer Joe gave me a call and he said, Jim, what in the world are we doing? This is crazy. The price of cows went from 100 bucks to 20 bucks a head. That was a stupid thing to do. I never should have got into cows. I'm like, wait a minute, Farmer Joe. You know that old John Deere tractor you have that you bought a long time ago? Well, it was during COVID, right? And I don't know if you remember this, but like after COVID, the hardest thing to find was a technician who would come to your farm, even if it was in the middle of harvest, and you were a farmer who bought a new John Deere tractor because they made all these incentives to sell the new John Deere tractors with all the technology. And you're the old farmer like Farmer Joe who, you're a mechanic, you could fix whatever, and you knew how to fix your tractor, right? But now you've got this tractor that's like super sophisticated and you can't fix it. But that old tractor that you have out back, that thing runs every day. It's not as efficient, it's maybe there does some things, but it works. It works, that old John Deere tractor. And that old John Deere tractor just turns out to be like worth as much as you paid for it because it doesn't have all the technology. So I'm like, Farmer Joe, maybe you should sell the John Deere tractor and buy some more cows. And he's like, what are you talking about? I'm like, think about it, Farmer Joe. You're buying 5 cows for 100 bucks where you were buying 1 cow when we started just a short time ago. Trust me, this is not the time to sell your cows. So he said, okay. The next month, cows go back up to 25 bucks a head and he buys 4 of them. Cool. The next month, cows go back up to 50 bucks a head and he buys 2 of them. Nice. The next month, cows are back up to 100 bucks a head and he gets 1 cow, calls me back up and says, Jim, I don't know. It seems like now might be a good time to sell cows. And I'm like, Farmer Joe, dadgum better selling them now than back when they were 20 bucks a head. Let's sell some. Maybe we can buy them back later for less money. I don't know. We'll see. But let's think about it. Let's look at what we've done. So we've invested in cows, 100 bucks a month for how many months? So we got 1, 2, 3 months, 4 months, 5 months, 6 months, 7 months. We got 1 cow, then we got 2 cow the next month, 4 cow the next month, 5 head the next month, 4 head the next month. So 1, 2, 3, 4, 5, 6, 7 months of $100 a month, right? Just do the math with me. How much did we invest in cows? Go ahead and leave a comment. I think somewhere in this thing we have probably all written here, but Farmer Joe invests a total of 700 bucks, right? How much are they worth? I'll just make sure that's on the screen. How much are they worth? How many cows does he own? Again, just count the heads. If you count them, I think you're going to come up with 19 cows that he bought over how many months? 7 months, 100 bucks each month. And so, yeah, how many cows does Farmer Joe own? 19 at 100 bucks a head. That's $1,900. Now, here's the real question. What kind of profit? How much money did we make investing in cows? If we sell all 19 cows for 100 bucks a head, how much profit? We invested 700. We sell them for 1,900. That's $1,200 profit. Now that's not the end of the story. That's just one. Let's call it one cycle, and it's only 7 months. It's not even a 1 year cycle. Trust me, folks. The market is going to do the same thing as the value of these cows did. Every year, typically, almost every year, the market has a nasty pullback, just like it's having now. Now, there's always a different reason for it. Where's Tesla at the moment? It's $9. Let's see. Meta. Meta is down 4% today. That's Facebook. That's a 3-month chart. Now, I'm not suggesting you invest in individual stocks. Again, if I were you, if I were anyone, even I think Warren Buffett says this. Best thing you can do is invest in the S&P 500. How do you do that? How do you invest in the S&P 500? It's simple. You invest in SPY. That is the S&P 500. So if you just look at that, you will see that the S&P 500 in 1 year, it was way up and then it came down. So again, we're talking about dollar cost averaging. Just think about the cows, the value of cows. Think about all the different asset classes. S&P 500 is just one asset class, the large cap stocks. So if you selected in your portfolio, in your 401k, if you selected 4 different asset classes, let's say you did the S&P 500, which is large cap stocks, and then you did another one. Let's see what small cap stocks are looking like. I think I have IMW, that's the Russell 2000. Ooh, look at that over 1 year. But that's another asset class. That's what asset allocation is. You want to have good asset allocation, and you want to be doing dollar cost averaging, because some things go up while other things go down. Let me find something that is going up today. I'm looking for bonds. I'm thinking bonds are going to be up today. If I can find TLT, it's on there somewhere. There it is. It's not really up. TLT is up or down 0.12%. But look at that chart. It's a little different. Look at a 3-month chart. So if you're buying cows, if you're dollar cost averaging, if you're investing with good asset allocation, and you have excuse me, you have set up your 401k to invest so many dollars per month, and you've selected your asset classes, large cap, small cap, international, bonds, you're going to be investing just like Farmer Joe did, and you're going to be able to, where did we go? You're going to be able to take advantage of the ups and downs of the market, and you're going to be buying at a discount. Now, the next thing you're going to do is portfolio rebalancing. And I'm just going to spend 30 seconds on portfolio rebalancing because we are out of time. But portfolio rebalancing, and you can read more about it, but it's basically just think about a circle, like a pizza with four quadrants, right? A circle with 4 different asset classes: large cap, small cap, international, bond. That's simple, that's easy, that's right, that's good. 4 asset classes. And let's say that you've been investing just like Farmer Joe, but instead of just buying cows, you're buying 4 different asset classes: large cap, small cap, international, and bonds. And over time, let's just say that the bond quadrant really went up. Interest rates came down, and bonds are inversely related. The value of bonds are inversely related to interest rates. So when interest rates go down, the value of the bonds went way up, but everything else kind of shrunk. So what are you going to do? You did the dollar cost averaging, and you continue to purchase these asset classes month by month with your systematic dollar cost averaging plan. But then every once in a while, every quarter, maybe twice a year, maybe once a year, you want to rebalance your portfolio, because when you do that, it's kind of like Farmer Joe saying, okay, cows are now at the very top of their price range, and chickens are now super on sale. So I'm going to buy more chickens, but I'm going to sell my cows right now. I'm going to push a button, rebalance my portfolio, sell my cows, and buy more chickens, because the price of chickens are now down where cows were. So just by hitting that button and doing portfolio rebalancing, you've taken your profits off the table and you've invested in another asset class that's in the commode. And that's how portfolio rebalancing works. So these 4 investment strategies: diversification, asset allocation, the number one determinant of your portfolio's returns, is the next one. Dollar cost averaging, which I think is the most powerful investment strategy available to you. And then the 4th one is portfolio rebalancing. So that's it for today. We'll be back next week for types of accounts. We'll do some more on asset allocation, but you're going to learn more and more about types of accounts next week. And we're going to continue to work on investing, including asset allocation. Hope you have a great week. I look forward to seeing your assignments, and we'll see you next time. Looks like my camera froze up. Okay.